Peter Eliades with you. This is Stock Market Cycle's YouTube update for the week ending Friday, March 11th, being recorded on Saturday evening, March 12th. Our last two updates discussed an analog between price action of the past month or so and crashes that occurred in 1929 and 1987. Obviously, we did not see a crash. Our last update was on this date right here, though. So, I mean, if you played the market for a crash, this is the NDX. You weren't too disappointed. We've had a nice little down move here. It started way back here, the all-time high in the NDX on November 22nd, a double top towards the end of December right here, and a closing high on December 27th. And a big move down, a little recovery, and then this second move down here. Again, our last update on YouTube was right here. So we cautioned you not to be playing for that crash unless you knew what you were doing or had your own ideas about it. We didn't want you to base it strictly on the analog we were showing you. So where does that leave us now? Obviously, a crash did not occur because our date for the analog was the very end of February, the first day of March. So we saw no crash there, obviously. But where are we now? That's the important thing. We want to show you a couple of things now. One of them technical, and the other one our specialty, which is cycle price projections, okay? This is a chart of the NDX. The NDX is a Nasdaq 100. It tends to be a market leader. And indeed, I believe you can say it has led to the downside, topping out here in late November. The S&P and the Dow topped out in early January. But this is where we stand today. And the question is, are we at the bottom of a typical decline that we've seen for the past several years, or is this just the beginning of something much more serious? Our contention is that that's the possibility. It could be the beginning of something a lot more serious. Let's show you a technical formation here. These dashed lines here are called speed resistance lines, 1/3 and 2/3 speed resistance lines. They were invented by an old market master, Edson Gould, now deceased, but probably one of the most talented market analyzers in the past half century or the past century, called a lot of market turns, some of them almost to the day. So he discovered these speed resistance lines, and I think if you're a technician, you'll really appreciate them. What you do, you can use them on any time span. You can use them very short term, from this low to this high, or from this high to this low, this high to this low. We've done it on a slightly longer term basis, from the March low of 2020 up to the all-time high in the Nasdaq 100 in late November, okay? And let's see how it's constructed here. You start at the low. This is for a rising 1/3 and 2/3 speed resistance line. There are declining ones also. But for the rising, you start at a low, and then you go up to a high. You click at the low and at the high. This is how TradeStation does it. And then what happens is the computer draws a vertical line from the low. It just comes across here to the low and moves it straight up to the high. And it measures the distance from low to high, okay? And breaks it into thirds. This is 1/3 of the way up. This is 2/3 of the way up. So this is called the 2/3 speed resistance line. The 2/3 is the steeper of the two, and this is called the 1/3 speed resistance line, okay? The theory is, if you break the 2/3 speed resistance line, you should fairly quickly get down to the 1/3. If you break the 1/3, you should fairly quickly get all the way back to where the whole measurement process started, which in this case would be March of 2020. Mind you, be careful, because speed resistance lines are not like trend lines. they give you an area of support and resistance, not exact lines. So you could say here, well, for example, it may break through for a couple of days, but generally, if it's going to hold, you'll see the pattern hold in the area of the speed resistance line. So now notice what happened here. Here's the all-time high in November of 21. We had this decline. It stopped almost exactly at the 2/3 speed resistance line. Had a big rally, came down again, stopped again at the 2/3 speed resistance line. Another rally, and then boom, a fairly convincing break of that 2/3 speed resistance line. And as often happens when a trend line or speed resistance line is broken, you attempt to regain it. The market attempt to get back to it and possibly reestablish itself above it. Well, here's that attempt to move back to the speed resistance line, and obviously it failed because it has now moved to an even lower low further below the speed resistance line. So the theory now says that the market should move down to the 1/3 speed resistance line. Doesn't give you any time elements, no parameters in terms of when. Generally speaking, I think that Gould said it should happen relatively quickly, but you can experiment with yourself and go back, look historically at these speed resistance lines. I think you'll be very impressed by them. I wanted to show this one to you because it is quite negative. Now, if you do the same thing on the S&P, I'm not going to spoil it for you. I'm going to have you do it yourself. Perhaps in a later update, we'll show you how the S&P looks with a speed resistance line. But this is the Nasdaq 100, and it is a bearish configuration. How about the 200-day moving average? That's this dark, solid black line. Almost the same thing happened there. Isn't that interesting? Right where we held at the speed resistance line, we initially held at the 200-day. Had a rally, came back towards the 200-day again, another rally, broke beneath it convincingly, rallied back up to the 200-day once and then twice and failed both times and has now gone further below it. Again, another part of a negative technical configuration. So I wanted to show those to you. Did they imply a crash? No, crashes, everyone loves to talk about crash. You go on YouTube and search for stock market crash. You'll see videos galore about stock market crashes, and that's why we felt a little guilty when we did ours about the crash, although it was a legitimate analog, and as a matter of fact, it was followed quite closely. So there's nothing to be ashamed about. We told you that the odds greatly were against seeing some kind of crash occur, okay? So, but does that mean that we now rule out the possibility of a serious market decline? No, not at all. I'm not talking about a crash anymore, although it still could happen. We don't rule it out. But what I'm talking about is the possibility of a very significant move to the downside. That's what this speed resistance line tells us. Let's see what our projections tell us. Okay, here's a daily chart, again, of the NDX. That's this dark line. It's closing prices, not intraday, but closing prices. And while I'm showing you this, I mentioned to you, I believe in one of my last two updates, the exponential 10-day moving average. It's a wonderful trend indicator. When you're below it, you can assume the trend is down. Short term. This is short-term trend, not long-term. When you're above it, you can assume the trend is up. Okay? Then you get a choppy period like this. You get below it, above it, below it, above it. But if you're in a concerted downtrend, generally you tend to stay below the exponential 10-day. We did our last update back here on the 17th and showed you this exponential 10-day. Look what's happened since then. We had a tiny attempt here to get above it and another one here, but we've been below that exponential 10 ever since we did that update almost a month ago. So it's been a wonderful indicator for the short-term trend. Here is a chart. This is an offset of 189 to 194 trading days. That's the equivalent of a 39 to 40 week offset, daily offset. These are trading days, okay? This line does not get, or these two lines do not get crossed very often by the market averages. When they do, they can be very significant. They have now been crossed to the downside by market prices, okay? And in so doing, they have generated a nominal 78 to 80 week downside projection on the NDX, calling for 10,486 and change to 10,976. This box right here, that's the projection box, okay? That's what this projection is called for. And that projection will remain in effect until it's either met or invalidated. This is the invalidation process right here. You would need to turn around and get back above both the offset lines. In fact, get above what we call a continuum. I'll show you that continuum on our web chart. Okay, here's the web chart. What the continuum is simply showing you all the spaces in between a 189 and a 194-day offset. Let me see if I can explain that for you quickly. The red line is the 189 trading day offset, the blue line 194. If you can imagine moving this red line slowly over to the blue line, all the territory encompassed within as you move it over is what you see in this continuum. And the continuum is important because we don't confirm a downside projection with a crossing until, if it's a closing projection chart, you get a close below the lower part of the continuum. If it's an intraday chart, as this one is, actually this is a closing one. We should show you the close. Here are the closing prices. So you do not get a confirmed downside projection until you cross below both the upper and the lower side of the continuum. As you can see, that has occurred. It didn't occur here. We got below the upper side of the continuum. This is back in the late February low, okay? Did not get below the lower continuum, rallied back up above, got into the continuum again, and finally, this low that we saw on March 8th, we got below and confirmed the downside projection. Now, in order to invalidate that, you need to close back above the complete continuum, okay? So there are only two options when a projection is generated. The projection is met by moving down to this shaded area, or it's invalidated by moving back above the continuum. So this projection is very much in effect, and it's a significant downside projection, as you can see. The S&P is a little bit different. It's almost confirmed the downside projection, but let's show it to you. Here's the S&P chart. Let's look at a couple of technical things first. Here's the exponential 10-day on the S&P. Same thing here. Came up to it, failed. Came up to it a little bit above it, failed. A little bit above it, failed. And now has started down again below the exponential 10-day. So there are a couple of things that need explaining here on the S&P, but let's show you the web chart with the continuum in order to explain them. Okay, here's the all-time closing high back here on the early part of January. Came down, rallied, and finally crossed below and on the S&P completely below the continuum, the upper and lower part of it. That was at the March 8th low again. But then we rallied back above it. And that's how you invalidate the downside projection. So if you were a bull, you could have said, phew, we invalidated that downside. So now we can continue to the upside and start giving upside projections. Not so fast. Just a few days later, going into Friday of this week, just yesterday, as I do this update on Saturday, look at what happened here. Let's zoom in on this part of it. We came down and closed below the lower part of the continuum, confirming for the S&P a lower nominal 78-week projection, nominal 78 to 80 week to be technically correct. Now, let me go back on this and show you something. Okay, Notice a couple of things here. We crossed below the complete continuum. That gave a downside projection. Here it is down here, calling for 36, 63.22 down to 35.89.14. But we got an invalidation by moving back above, okay? Then move back down below. Well, it's very difficult for the software to handle things unless you're there to help it out and tell, what are we looking at here? Are we still using this high to determine what the projection calls for? Because if we are, we measure from the high to the crossing level, both the higher part and the lower part of the continuum, and then give the projection down to here. But what the computer did was, because we crossed down below and then invalidated the projection temporarily, it recognized the move above and through the continuum and gave an upside projection right here, because this was below the continuum and moved above it, gave an upside projection. As it turned out, that upside projection was met right within the projection window. And now we have came down, and it's using this high and this crossing as determining where the projection gets to, okay? Well, that's not what we want. And there's a way to get around that. Let me show you. Okay, what we want the computer to measure is the closing high back here, if this is a closing projection, to where the cross takes place here, to get us below the complete continuum. And here's how we do that. This was a tiny move here that got back above, okay? We want the computer to ignore that move now that we've gone back below again. If we had stayed above there, no, we don't want it to ignore it at all. It's telling us, hey, that downside projection, you can forget about it. It's no longer in effect. But now that we move back down below again, we want the computer to ignore this crossing here. And the way to do it is to double click on the offset lines, go to this nick filter period, okay, and we can put in a filter of 1. It's going to be 1 or 2, but I think 1 will work. And what that's telling you is, hey, we might have gotten back above the offset for 1 day. If we did, ignore it. Consider it as not having happened, because we still want to use this high and this crossing as a measurement tool. So now watch what happens, okay? Here's the old downside projection that's been grayed out because it got invalidated technically. Let's see what happens when we put the nick filter in. Look at this. It's been reestablished. Live projections that are still outstanding are either red for downside or green for upside, okay? And this is now red again, so it is a live downside projection for the S&P, and it calls for 36.4254 to 36.8709. I don't have to tell you, that's a pretty good distance down from here. Now, on the S&P, it would be easier to invalidate, easier than the NDX, because as you can see, all we need to do is get right back above these lines again, and as long as you stay there, you've invalidated this downside projection. I don't think that's going to happen, but the computer, the projections don't care what I think. If we get back above this line once again, we will invalidate this downside projection. For the time being, again, only 2 things can happen with a projection. They can be met or invalidated. And so I wanted you to see these 2 downside projections for the S&P and for the Nasdaq 100 that are very much in effect as of the close of the market on Friday, March 11th, okay? And that's all we need to show you right now. We want to thank you for watching this update. Please spread the word around. The more people that watch, the more attention that they get, and the more respect we get for our cycle work, which we appreciate. If you feel up to it, write some kind of favorable comment, and we would appreciate that very much. Give us a thumbs up. But most of all, respect what you're looking at here, because this is the way the market works, folks. Thanks for watching. We'll talk to you soon.